The latest quarterly report from Berkshire showed more than $380 billion in cash and U.S. Treasury bills. At the same time, for the 12th straight quarter, Buffett and his investing lieutenants were net sellers of stock. They sold more than they bought. Again, that is the opposite of their historical pattern. Years ago, Buffett told CNBC it was hard to think of many months when Berkshire wasn't a net buyer of equities. For most of his career, he has wanted more exposure to productive assets, not less. But something changed about 3 years ago. Since then, the cash pile has kept growing, and the stock portfolio has, on net, been shrinking. To understand why that matters, you have to step back from the day-to-day noise of markets and look at the environment Buffett is operating in. Start with valuations. One way to judge whether the stock market is cheap or expensive is to look at the cyclically adjusted price-to-earnings ratio, known as the CAPE ratio. It's a measure developed by Nobel laureate Robert Shiller that compares current prices to average inflation-adjusted earnings over the last 10 years. It smooths out temporary booms and busts in profits, so you can see the underlying relationship between what investors are paying and what businesses are actually generating. In October, the CAPE ratio on the S&P 500 hit 39.5. That number might not mean much at first glance, but the context will get your attention. Since the index was created in 1957, there have been more than 100 months of data. Out of all those months, the CAPE ratio has crossed above 39 just 22 times, roughly 3% of the time. Put differently, for about 97% of modern market history, U.S. stocks have been cheaper than they are right now when measured this way. The only other period when valuations were this stretched was the final feverish stage of the dot-com bubble between 1999 and 2000. That is where history starts to speak very clearly. In January 1999, the CAPE ratio crossed above 39 as investors poured money into anything related to technology and the internet. For nearly 2 years, it stayed elevated. Then reality intruded over the following 3 years. The S&P 500 fell roughly 40% from peak to trough, and the NASDAQ lost almost 80%. Many individual investors who thought they were buying the future ended up owning stocks that never recovered. When researchers go back and ask a simple question, what typically happens to the S&P 500 after the CAPE ratio climbs above 39? They get sobering answers. On average, the index lost around 4% over the next year, 20% over the next 2 years, and 30% over the next 3. That doesn't guarantee the same pattern will repeat, but it does tell you we are in rare territory. Imagine you are a pilot and you see a warning light that is turned on only once before in all the flights you've ever studied. The last time that happened, the plane hit violent turbulence and lost altitude. You wouldn't ignore that light just because this time might be different. You would at least check your instruments and tighten your seatbelt. Buffett's cash hoard is his way of tightening Berkshire's seatbelt. Of course, valuations aren't the only factor here. Berkshire today is much larger than it was a decade ago. That sheer size limits the number of investments that can move the needle. Buying a billion-dollar company hardly matters to a conglomerate worth hundreds of billions. So, some of Buffett's reluctance to deploy capital is structural. He is fishing and has fewer big fish than he used to. But that explanation by itself is not enough. Even mega capitalization stocks trade at attractive prices once in a while. If Buffett saw many of those opportunities today, Berkshire's cash balance would not be where it is. Underlying his behavior is a simple comparison. What can he earn safely versus what he is being offered in the stock market? For most of the last decade, safe assets like Treasury bills paid almost nothing. In that environment, even somewhat expensive stocks could still be the best choice because the alternative was effectively zero. But rising interest rates change that math. When Berkshire can earn a decent yield holding government debt, the bar for buying stocks goes up. Stocks must offer a margin of safety and a return potential that clearly beats what's available in treasuries. At current valuations, Buffett seems unconvinced they do. Look at how he has responded in past cycles when valuations were stretched. In the late 1990s, he was widely criticized for refusing to chase internet stocks. Berkshire carried more cash than usual and focused on boring businesses with solid earnings. During the mania, that stance made him look old-fashioned. Some fund managers called him a has-been who didn't understand the new economy. Then the bubble burst, and many of those critics disappeared, along with their funds. Buffett, holding cash and owning resilient companies, not only survived, but was positioned to buy when others were forced to sell. A similar pattern emerged before the financial crisis. As leverage and complex derivatives spread through the banking system, Buffett warned about the risks and limited his exposure. Berkshire's balance sheet had ample liquidity heading into 2008. When fear peaked, he stepped in with capital infusions to firms like Goldman Sachs and General Electric on very favorable terms. Those deals were possible because he had not tried to squeeze every last bit of return out of the preceding boom. He had accepted lower, safer yields for a while so that he could take intelligent risk when the payoff was much better. Now think about the current environment through that lens. Long bull markets have a way of teaching people the wrong lessons. 12 or 15 years of mostly rising prices convince investors that weakness is always a buying opportunity, that central banks will always step in. That time in the market solves all problems. Many people came to believe that as long as you own an index fund and never sell, everything will work out smoothly. What those narratives leave out is the sequence of returns. If you are still saving heavily, a long sideways period or big drawdown may not hurt you too badly. But if you are nearing retirement, relying on your portfolio for income, or heavily concentrated in expensive sectors, the path the market takes in the next few years matters a great deal. History suggests that starting from lofty valuations leads to lower long-term returns and more volatility, especially over the first several years. A CAPE ratio near 40 simply doesn't leave much room for disappointment. Earnings can surprise to the upside for a while, but they can't outgrow very high multiples forever. Eventually, either profits stumble or investor confidence cools and prices adjust. That adjustment doesn't need to be a sudden crash. It may come as a grinding sideways market where inflation quietly eats away at real returns, or it may come as sharp declines followed by choppy recoveries. Either way, people who bought at the top as they felt pressured to stay fully invested often find themselves underwater just when they need liquidity. Buffett is trying in his own way to avoid that trap for Berkshire shareholders by building a war chest. Now he increases the odds that when stocks are cheap again, he can buy aggressively. That's where the message for individual investors comes in. You don't manage a giant conglomerate, and you won't get phone calls from CEOs begging you for capital. But you do face the same basic trade-off between risk and reward. When the market is historically expensive, you have two broad choices. You can act as if nothing has changed. Keep buying the same assets at higher prices and hope that this time really is different. Or you can accept slightly lower returns in the short term by holding more cash in high-quality defensive positions, giving yourself the ability to act if and when better bargains appear. Notice that none of this requires trying to pick the exact top of the market. Buffett is not saying he knows precisely when stocks will fall or how far. He's saying the current balance of risk and reward doesn't justify being aggressive. That is a subtle but powerful distinction. He's not timing, he's discounting. When the odds aren't clearly in his favor, he doesn't bet big, he waits. There is also an important psychological dimension to his warning. When markets reach extreme valuations, they often generate emotional extremes in investors. Euphoria on the way up, denial when things start to crack, and finally panic when losses mount. During the euphoria phase, people are more likely to ignore uncomfortable data. They downplay metrics like the CAPE ratio or the concentration of returns in a handful of giant companies. They reach for narratives that justify the price. Artificial intelligence changes everything. Interest rates will soon go back to zero. Corporate profits will stay near record margins forever. The stories might contain some truth, but they are stretched to support valuations that already embed a lot of good news. Buffett's behavior cuts through that noise. Instead of debating whether this innovation or that policy will keep the bull market going, he looks at the numbers. How much am I paying relative to normalized earnings? What are my alternatives? How confident am I that the next decade will be as favorable as the last? When the answers don't meet his standards, he raises the cash level. The fact that he has been a net seller for 12 consecutive quarters is not a random fluke. It is a pattern consistent with his view that the market in aggregate is not offering him many fat pitches. For investors paying attention, the contrast between his posture now and his posture coming out of previous downturns is critical. After the financial crisis, Buffett wrote in his annual letter that he and his partner, Charlie Munger, felt they were getting more than fairly compensated for the risk they were taking. You can hear the excitement in his words from that era. He was eager to buy, not reluctant. Today, the tone is very different. He talks more about the scarcity of truly attractive big deals, about the power of keeping cash in short-term treasuries, and about the importance of not stretching for yield just to be doing something. What does all this imply about what the stock market is likely to do next? Strictly speaking, no one knows. But the historical record suggests a few realistic scenarios. One is that valuations normalize as earnings grow more slowly, and investors demand higher risk premiums in a world where safe yields exist again. That could mean a period where indexes move sideways in nominal terms while inflation erodes real returns. Another scenario is a sharper adjustment triggered by a recession, a policy misstep, or a geopolitical shock. In that case, indexes could drop quickly, perhaps 20 or 30% before stabilizing. A third possibility, less likely, but always talked about at peaks, is that extraordinary innovation justifies current prices and more. That's the "this time really is different" story. Buffett is essentially betting that the odds of the first two scenarios are high enough that he doesn't want Berkshire to be exposed as if the third scenario were a sure thing. That's his warning. He doesn't have to shout it from a stage. The numbers on Berkshire's balance sheet are already doing the talking. For ordinary investors, the most constructive response is not fear, but clarity. Instead of asking, "Is a crash coming?" ask, "If the next 3 years look more like the post-dot-com period than the last decade, am I prepared? If the S&P 500 were to deliver negative returns from today's level over a multi-year stretch, would your financial plan still be intact? Would you be forced to sell assets at the wrong time to cover expenses? Are you leaning heavily on stocks that have benefited most from the valuation expansion of the last several years?" One practical step is to systematically reduce exposure to the riskiest, most overvalued corners of your portfolio, especially positions you own mainly because they have gone up a lot or because everyone else seems to own them. Another step is to gradually build a cash reserve, not as a permanent hiding place, but as future ammunition. Think of it like saving dry powder before a storm. You don't know exactly when the rain will come, but you know that markets eventually serve up periods when good companies trade at bad prices. If you have no spare capital when that happens, you can only watch from the sidelines. At the same time, it is important not to swing from one extreme to the other. Selling everything and waiting for a perfect entry point is just another form of trying to time the market. History shows that staying completely out of equities for long stretches is usually a mistake. Productive assets owned at reasonable prices are still powerful long-term wealth builders. Buffett himself has kept large positions in companies like Apple, insurance subsidiaries, railroads, and consumer brands. The difference today is that he is not rushing to add more at current valuations. He is content to let solid holdings compound while he waits for the market to offer him fresh opportunities at better prices. That balance, owning quality, trimming excess, and respecting cash, is the posture that lines up best with his $382 billion message. It acknowledges that the future is uncertain, that extremes in valuation rarely last forever, and that patience has a real financial payoff when the cycle turns. So when you hear that Buffett is once again a net seller, even with a cash mountain big enough to buy most companies outright. Don't treat it as trivia. Read it as a carefully worded note from someone who doesn't often change his approach. The note says, "Choices you make now, at this level of valuation, will shape your returns for years. You can ignore that and hope history stops rhyming, or you can tilt the odds in your favor the way he has always tried to do, by refusing to overpay, by valuing safety when others are complacent, and by keeping enough cash ready for the day when fear finally replaces greed. When that day arrives, the investors who prepared will not be the ones asking, 'How could this happen?' They will be the ones quietly doing what Buffett has done every time the market has reset in his lifetime, buying pieces of great business from people who suddenly realize they paid too much." The warning is already on the table. The question is whether you're listening and how you plan to respond.